The silver market just delivered one of the most dramatic reversals investors have seen in years. Only days after traders celebrated what looked like the beginning of a historic breakout, the entire market suddenly flipped. Prices plunged violently. Billions were wiped from leveraged positions. Retail traders rushed for the exits. Financial media immediately declared the rally over. But behind the headlines, something far more important may be unfolding. Because according to several analysts watching the metals market closely, this may not have been the collapse of the silver bull cycle at all. It may have been a stress test of the entire financial system surrounding precious metals. Tonight, we break down what really happened inside the silver market, why the move became so extreme, what institutional money may be doing right now behind the scenes, and why some veteran commodity investors believe this event could actually strengthen the long-term case for silver instead of destroying it. This is not just a story about one commodity. It is a story about leverage, liquidity, inflation pressure, central bank policy, industrial shortages, and the growing battle between physical assets and paper markets. And the implications may extend far beyond silver itself. Welcome back. Over the past several months, silver had been building momentum at a pace that surprised even experienced traders. While gold dominated headlines earlier in the cycle, silver began outperforming rapidly once industrial demand accelerated and speculative money returned to the metals sector. Momentum traders piled in. Institutional funds increased exposure. Retail investors flooded social media with predictions of triple-digit silver prices. Mining stocks surged. Futures volumes exploded. The atmosphere started to resemble previous commodity manias. And then came the reversal. Within less than 2 trading sessions, silver experienced a violent downside move that erased weeks of gains. Traders who entered late near the highs were suddenly trapped in collapsing positions. Margin accounts came under pressure. Leveraged ETFs experienced massive volatility. Stop-loss orders triggered across the market. To newer investors, the crash looked catastrophic. But to veteran commodity traders, the structure of the move looked strangely familiar. Because historically, some of the sharpest corrections inside precious metals bull markets have occurred precisely when momentum becomes overheated near psychologically important price levels. That distinction matters. Markets rarely move in straight lines, especially commodities tied to speculation, monetary policy, and global liquidity conditions. And silver is known for being one of the most volatile major assets in the world. In fact, silver has a long history of explosive rallies followed by brutal corrections that shake out weak hands before the next phase higher begins. To understand what may be happening now, we first need to examine why silver had been rising so aggressively in the first place. The first major driver was industrial demand. Unlike gold, which is primarily viewed as a monetary metal and store of value, silver plays a dual role in the global economy. It is both a precious metal and an industrial resource. That means silver demand is increasingly tied to technology manufacturing, energy infrastructure, and advanced electronics. Solar panels require silver. Electric vehicles require silver. High-performance electronics require silver. Medical technologies use silver because of its conductive and antibacterial properties. And as governments around the world continue pushing energy transition policies, demand forecasts for silver have surged dramatically. At the same time, supply growth has struggled to keep pace. Several mining regions have faced operational disruptions, rising costs, labor shortages, and declining ore grades. Analysts have repeatedly warned about structural deficits forming in the physical silver market. That imbalance became one of the central bullish arguments behind the rally. The second major driver was monetary policy. For years, investors operated in an environment dominated by ultra-low interest rates and massive liquidity injections from central banks. But after inflation surged globally, policymakers were forced into aggressive tightening campaigns. The problem is that higher rates created stress across debt-heavy economies. Governments now face rising borrowing costs. Consumers face weaker purchasing power. Businesses face slowing growth. And many investors believe central banks may eventually return to looser monetary conditions to stabilize financial systems. That expectation has fueled renewed interest in hard assets. Historically, Precious metals tend to attract capital during periods of currency uncertainty, debt expansion, or declining confidence in fiat purchasing power. As inflation concerns intensified again this year, silver increasingly became viewed not only as an industrial metal, but also as a hedge against monetary instability. Then came the speculative wave. Once silver broke through several major technical resistance zones, algorithmic traders and momentum funds accelerated buying pressure. Retail traders joined aggressively, creating a feedback loop of rising prices and growing optimism. But markets driven heavily by momentum can become extremely fragile. When too many participants crowd into one side of a trade, even a small reversal can trigger chain reactions. And that appears to be exactly what happened. The first stage of the sell-off was relatively normal. Large institutional traders who had accumulated silver at lower prices began taking profits near key resistance levels. This is common behavior in commodity markets. Professional money managers rarely wait for the exact top. They scale out near major psychological levels where volatility is expected to increase. Once enough selling pressure appeared, short-term momentum indicators weakened. That triggered automated trading systems. Modern markets are increasingly dominated by algorithms capable of executing enormous volumes within fractions of a second. Many of these systems react automatically to technical signals, volatility spikes, or momentum shifts. When support levels break, algorithms often intensify the move by selling additional contracts. As silver dropped, more systems activated. Then macroeconomic conditions added fuel to the fire. The US dollar strengthened sharply during the same period. Treasury yields moved higher. Investors recalibrated expectations around future Federal Reserve policy. Those factors matter enormously for precious metals. Silver and gold are typically priced in US dollars. When the dollar rises, commodities often face downward pressure because they become more expensive for international buyers. At the same time, higher bond yields increase the attractiveness of interest-bearing assets compared to non-yielding metals. Even a temporary shift in macro sentiment can create massive volatility in leveraged commodity markets. But according to some analysts, those explanations alone do not fully account for the severity of the move. Attention quickly turned toward the futures market itself. This is where the story becomes far more controversial. Critics of the silver market have long argued that paper trading volumes in futures exchanges vastly exceed the amount of physical silver actually available for delivery. In simple terms, enormous amounts of silver exposure can be traded electronically without corresponding physical metal changing hands. Supporters of this system say it improves liquidity and price discovery. Critics argue it creates opportunities for excessive leverage and artificial price suppression. During periods of extreme volatility, that leverage becomes dangerous. Because when futures traders use borrowed capital, they must maintain minimum collateral requirements known as margin. If exchanges raise those requirements during a volatile period, traders suddenly need additional cash to keep positions open. And if they cannot provide it quickly enough, their positions are forcibly liquidated. That forced selling can accelerate market collapses dramatically. Historically, precious metals markets have experienced several famous episodes where margin changes coincided with violent corrections. The most well-known example occurred in 1980 during the Hunt brothers silver episode. At the time, silver prices skyrocketed as wealthy investors attempted to accumulate enormous quantities of the metal. But as volatility exploded, exchange rules changed, leverage tightened, and prices collapsed. Another major example came during the 2011 silver rally, when repeated increases in margin requirements contributed to sharp downside moves after silver approached major highs. Today, some market participants believe a similar dynamic may be reappearing. Whether one agrees with that interpretation or not, one fact is clear: leverage magnifies everything. It magnifies rallies. It magnifies panic. And when liquidity disappears, markets can move with terrifying speed. But here is the key question investors are now asking. Did the recent crash damage the long-term silver thesis? Or did it simply reset excessive speculation temporarily? That debate is now dividing Wall Street. Bearish analysts argue that slowing global growth could weaken industrial demand. They point to rising real yields, persistent dollar strength, and the possibility of tighter monetary policy lasting longer than expected. Some also warn that speculative excess had reached dangerous levels and required a correction. Meanwhile, bullish analysts counter that the structural drivers behind silver remain largely unchanged. Industrial demand forecasts are still strong. Renewable energy expansion continues globally. Supply constraints remain unresolved in several major mining regions. And perhaps most importantly, debt levels throughout the global financial system remain extraordinarily high. That last point may become critical, because many investors believe central banks will eventually face a difficult choice: maintain restrictive policies and risk economic instability, or return to liquidity expansion to support growth and financial markets. If monetary easing returns while inflation remains elevated, hard assets could once again become major beneficiaries. Silver bulls believe that possibility has not disappeared at all. In fact, some argue recent volatility may have transferred silver from short-term speculators into stronger institutional hands. There are also growing discussions about the difference between physical ownership and paper exposure. During periods of market stress, some investors prefer holding physical bullion rather than leveraged financial contracts. That distinction has become increasingly important as trust in broader financial systems fluctuates. At the same time, mining equities are drawing renewed attention. Historically, mining stocks often act as leveraged plays on precious metals prices. When silver rises strongly, smaller mining companies can experience outsized gains. But they also carry operational, geopolitical, and financing risks. Analysts are now closely watching whether mining shares stabilize or continue weakening. Their performance may provide clues about institutional confidence in the broader metals sector. Another major indicator being monitored is the gold-to-silver ratio. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. Historically, when silver begins outperforming gold aggressively, the ratio declines. Many commodity traders view that as a sign of increasing speculative appetite and economic optimism. If the ratio starts falling again after this correction, it could indicate silver leadership is returning. If it rises sharply, investors may rotate back toward gold as the more defensive precious metal. Currency markets will also play a decisive role. A sustained rise in the US dollar could continue pressuring metals temporarily. But if dollar strength fades and liquidity conditions loosen globally, silver could regain momentum rapidly. This is why experienced traders are focusing less on emotional headlines and more on structural indicators.